Hello everyone, my name is Jake and welcome to Growth Academy. If you're new, please consider subscribing for more content like this one. Michael Burry anticipated the dot-com boom, the 2008 recession, and the growth of GameStop. With each short-term occurrence, Burry gained millions, if not billions of dollars. Michael Burry now believes that the largest crash in U.S. history is imminent, and like every prior forecast, Burry is putting enormous money on it. If Burry's prognosis is true, the stock and cryptocurrency markets may plummet by up to 95%. This video will explain why Burry is wagering billions on an impending financial market catastrophe. When Michael Burry makes a big prediction, unlike many other market collapse forecasters, you must take him seriously. Burry has hundreds of millions of dollars at stake and a stellar track record. Burry produced huge sums of money for his clients from 2000 to the first quarter of 2008, averaging a return of 28.6% every year. And if you thought Burry was a one-time wonder, think again. Since the beginning of 2016, his new fund, Scion Asset Management, has produced a 22.8% annual return. These figures are remarkable, especially given his 14-year investment track record. Given this knowledge, it's critical that you at least listen to what Burry has to say. Even if you have any preconceived beliefs, huge institutions and strong government officials do not want you to see what I am going to demonstrate. In reality, immediately after the SEC visited Michael Burry, his Twitter account was suddenly wiped, prompting me to crawl through massive quantities of deleted tweets in order to uncover Burry's most unusual warning ever. Michael Burry isn't only predicting a stock market catastrophe, he's also predicting America's demise. Burry believes that the approaching collapse will have an impact on nearly every asset, including cryptocurrency, gold, equities, real estate, bonds, and many more. But before we get into why Burry believes every asset class will crash, we must confront the elephant in the room, which is inflation. Almost everything in Burry's big gamble is linked to an impending inflation in the U.S. dollar. According to Burry, the U.S. government is courting inflation with its MMT-tinged policies. Rapid debt, GDP growth, M2 rises, and retail sales, PMI Stage 5 recovery, trillions of dollars in more stimulus, and reopening to stimulate demand while labor and supplier chain expenses soar. Burry's whole thesis revolves around the devastation caused by modern monetary theory, abbreviated MMT. MMT is a macroeconomic theory that asserts that the government should borrow or print money until their economy reaches full employment. In other words, during a recession, the government should raise the money supply of their currency until the unemployment rate returns to normal levels. The Federal Reserve employs MMT now, although there are still serious issues regarding the idea. To begin with, the United States debt as a proportion of GDP is now at an all-time high. Furthermore, M2 money, which is a measure of the entire money supply, has hit all-time highs. All this money creation and borrowing is taking place when businesses are already rebounding, as seen by the Purchasing Managers Index, or PMI in short. The PMI is an index that measures whether or not businesses are in excellent shape. In recent months, the PMI has surpassed pre-pandemic highs. As a result, many individuals are questioning why the United States government is continuing creating money. Consumer prices are already rising across the board as supply networks struggle to keep up with demand. Michael Burry argues that this situation is quite comparable to the early 1920s hyperinflation in the German market. According to Burry, prices in Germany were steady and both business and the stock market were thriving. The exchange rate of the mark versus the dollar and other currencies actually climbed for a while, and the mark was temporarily the strongest currency in the world on the brink of inflation. Germany's position is comparable to what is now taking place. The US dollar is the world's strongest currency. Consumer prices are rising, but remain largely stable. The stock market is thriving. The value of the US dollar has also risen in recent months. Burry then went on to say, side by side with the affluence, there are areas of destitution. As more individuals stayed on the outside of the easy money, gazing in but unable to enter, the crime rate increased. Simply said, only the rich in Germany had access to the easy money investments. Thus, those in poverty began to resort to crime as a solution because these investments were easy for a purpose. According to the report, almost any type of firm could generate money business failures, and bankruptcies were infrequent. The boom halted the regular processes of natural selection by which the non-essential and ineffective would otherwise have been pointed out. With such significant individual and institutional investment activity, German brokers were unable to keep up with trade documentation. As a result, the Robin Hood of Germany Bourse has to close down on occasion in order to work on the company's backlog of deals. What I just described is quite comparable to the current scenario in the United States, in which many assets are highly speculative and have hit all-time highs. Burley believes we are in the midst of the greatest speculative bubble of all time in all things by 2 orders of magnitude. Burley believes that when this speculative bubble bursts, severe consequences will follow. In other words, Germany's financial market crashed as a result of the speculative bubble. However, German citizens did not lose their money as a result of the collapse. They had already lost it due to speculation and inflation, but they were unaware of it at the time. Burry is effectively stating that Germany's financial market was 8 years in the making before it exploded. This information may appear alarming, but there are steps that investors like you and me can take to prepare. A conventional investor would advise you to invest in inflation-protected assets such as real estate, diamonds, gold, commodities, and collectibles to prepare for inflation. Burry, on the other hand, believes that investing in these assets would be a stubborn move. Burry is basically saying that during a crisis, the government will want to seize control of everyone's assets, including gold and Bitcoin. Some argue that because Bitcoin is decentralized, the government will be unable to regulate it. Nonetheless, Burry sees greater issues with Bitcoin. Crypto has a lot of long-term promise, but individuals have taken on far too much debt in the market. As a result, Burry believes that the crypto bull run will be short-lived since there is so much leverage in crypto that a tiny fall in price may set off a tremendous downward spiral. This is due to the fact that when one crypto investor in margin loses money, they will be margin called, causing prices to fall. As prices fall, other investors will be margin called as well, causing prices to fall even more. As a result, additional investors are margin called, forcing prices to fall once again. This negative cycle might potentially continue until everyone is margin called. According to Burry, if you don't know how much leverage is involved in the run-up of cryptocurrency, you may not know enough to own it. Burry's prognosis is intriguing in that he feels nearly everything will be severely impacted. Burry claimed that today's fads, such as Bitcoin, electric vehicles, software as a service, and meme stocks, are comparable to housing in 2007. According to Burry, nearly all equities, cryptocurrencies, commodities, gold, and real estate are doomed. So if everything is about to fall, where should we put our money? During an inflationary period, the objective is to invest in businesses that maximize capital costs while minimizing input costs. In an inflationary environment, a toll bridge would be a fantastic thing to buy because you've laid out the construction costs. Warren Buffett famously stated, "You created it with old money, and you don't have to replace it." A toll bridge not only has a lot of pricing power, but it also has very low to no input expenses. People will not quit using toll bridges because of the price increases. People on the other side may quit purchasing Ford vehicles if the costs double. Not only that, but because Ford's input prices rise during inflationary periods, the automaker is unlikely to remain profitable. To summarize, Michael Burry believes that inflation is poised to take off and destroy a wide range of financial assets. Are you prepared if Burry's prophecy comes true? As always, if you enjoyed this video, please hit the like button and subscribe. I'll see you in the next one.